Let us look at some practical examples out of some of the biggest and the best investors who have practiced focused investing. So I've just tried to put here a 10-year track, very long-term track record of Charlie Munger and Buffett and how they have fared in a long period of time. Now, if you look at on the left-hand side, Charlie Munger's performance shows a lot of volatility. He has quite a number of years when he has done very badly. For example, below, his returns have been down by 30% as well in some years and significant underperformance to the market too. But if you look at the aggregate performance over a very long period of time, the CAGR works out to be still substantially ahead of what the market has done. Whereas on the other side, Buffett's portfolio and Buffett's experience has been much better. He has had consistent performance and at the same time delivering results which are significantly better than that of the market. So you can end up with different shades of volatility depending upon your portfolio configuration, even within a focused portfolio. But if your investment horizon is reasonably long, then the outcomes over a long period of time always tend to be better through a method of focused investing. Now, which are there are a couple of other important considerations which are kind of intangibles. The third one probably rather is the nature of capital. That's a very important consideration. Are you running permanent capital, which is close-ended money, which you have for good and you're not going to be questioned on it, whatever you do, irrespective of whatever market cycles are and whatever the markets throw up to you, then there is a different outcome. But if you don't have a permanent source of capital, and that is what mutual fund industry at least is all about. Many of us as fund managers are dealing with money which is kind of tends to be volatile. Questions around the applicability of that money to the right stocks, to the right portfolio configuration comes very, very frequently. In the sense that, if you don't have 2 months of performance, it is very likely that investors will start looking at it differently and have second thoughts on whether they bought the right product or not. When you're dealing with permanent sources of capital, then your ability to run focused portfolios is much higher. When you're running public sources of capital, then it is better that you run diversified portfolios because you will not be able to bear the gut-wrenching volatility that you would probably have when running focused portfolios. So that's a very important consideration. The fourth consideration, but in my mind the most important consideration, is temperament. You can't get away with this. And that is something which differentiates whether a person is going to go for diversified portfolios or focused portfolios. It is something sometimes that we are only born with. So some people are very confident and very, find doing focused investing, it comes very easily to them. For many investors, it doesn't really come very easily. It's about temperament, it's about mindset. It requires focused investors are a rare breed. You don't see them very often. Yeah, they have a mind of their own. They don't get swayed by market conditions on a daily basis. They don't worry about what your neighbor has to say or what your neighbor has bought. They're simply focused on the 20-odd businesses or the 25-odd businesses, not even the stocks, the businesses that they have bought for themselves, and they're obsessed with what those companies are going to do for them. So it calls for a completely different kind of approach, a different kind of mindset. You have the ability to, suffer volatility. You need that power in your gut to be able to take those periods when your portfolios probably don't do anything versus the market which will be in a frenzy. So those are the things which are very, very important, which significantly differentiate a focused investor from a diversified investor. So I cannot beyond a particular point overemphasize the importance of temperament in the style of investing. So just to lay down the differences between focused and diversified philosophies, focused returns, you're looking for exceptional returns. In focused style of investing, you're looking for exceptional returns. In case of diversified portfolios, you're basically looking for acceptable returns. That is a key difference, in my view, in terms of what kind of approach you would adopt. Absolute return focus is more important for people who run focused portfolios, whereas as diversified managers are more worried about relative performance on a day-to-day basis. We have Or the second most important thing, which again it can't be overemphasized, is the kind of due diligence that you put in. You have only 20 stocks, but you have to make sure that each of these companies is well researched and well understood by you. You have to spend the maximum amount of time in doing your due diligence. You're taking positions which are 7%, 8%, 10% of your portfolio. You can't afford a situation where you have understudied that industry, understudied that company, and it backfires. So a lot of due diligence needs to go into focus portfolios. You can do with moderate levels of due diligence if you're running diversified portfolios. As I said, you probably run focus portfolios typically on close-ended capital, more permanent capital. If it is not permanent capital, then you're better off running diversified portfolios. The other thing is that if you are running a focus portfolio, then it is best that you have a certain level of competence in understanding the markets and understanding businesses and companies. That is the difference between what I call as a know-something investor and a know-nothing investor. A know-nothing investor, which is what we encounter in daily lives as our clients, our lay investors who are small shareholders. We want to ensure that their money is put to work in the right manner. They are not in a position to understand companies and do a full-fledged research. We as their fiduciary managers need to do enough of that so as to ensure that we don't end up in the wrong direction as far as the focus portfolios are concerned. So these are some of the key differences which I would like to put on the table, which differentiates a focused investor from a diversified investor. Now, what will help us decide in doing this? Should I adopt a focused strategy or should I adopt a diversified strategy? In our view, there are four goalposts which you can probably think of. One is you define what is that you are trying to achieve. Are you trying to maximize returns? Are you trying to gain or aim for exceptional returns? Or are you probably going to settle for moderate returns? That is an important criteria which will help you decide as to whether you should run a focused portfolio or a diversified portfolio. The other thing is, what is the kind of due diligence and investment process that I follow? Am I in a position to follow a rigorous investment process? If I can do that, then I'm better off. Then I would rather follow, I would advocate that one follows a focused approach, because you can simply do wonders to your returns and simply do wonders to your portfolio. Okay, but if you're not so inclined, then it is better to diversify. The third thing is, what is the kind of allocation that you are capable of doing? If you have done your due diligence and if you believe that you have developed an edge in investing or you have developed an edge in understanding that industry and that company, then bet big. That is how you will get your payoff. If you feel that you're not confident and you have not understood that company as well and you're probably acting on superficial information, then you're better off not betting big, diversifying the portfolio and taking very small incremental bets. Outcome will be different, but that is how life is. So rational allocation is another decision that you have to take in order to decide whether you want to run focused or diversified strategies. And last but not the least, are you in for active monitoring of your portfolio? If you can't do that simply because you are a businessman, you don't have time or you don't understand it, then again stay out of doing focused investments, run with a diversified portfolio. So I think these 3 or 4 principles will allow investors or fund managers, in my view, to decide whether they want which side of the strategy that they want to be in. What is the Indian experience? This is slightly dated data, but I don't really think this would have changed materially. We have almost about 286, maybe this number has gone up a little more, equity mutual funds, equity schemes, of which we find that only 51% run with, only 13% actually run with stocks which are in that 15 to 20 stock portfolio range, so very focused portfolios. A vast majority of the funds and the schemes that we encounter in the market are run on diversified formats. In terms of AUM, it is even more skewed. 84% of the AUM today which is run in the market is run on very, very diversified portfolios. So essentially the market is largely about moderate to acceptable returns. A large part of the money in this, a very small part of the money in the system is actually gunning for exceptional returns. In conclusion, therefore, what is important. Therefore, we started off by saying that selection of stocks is very important, but at the same time, we believe that due consideration needs to be given to how you size your portfolio. Sizing of the portfolio will decide whether you are a focused investor or a diversified investor, and that is what will make the key difference between your return outcomes. Typically, it is believed that stock markets are fairly efficient, and if that is the case, then if at all you have developed an edge in identifying certain investment ideas which you believe you have done a better job at understanding compared to the rest of the market, then it makes a lot of sense to run a concentrated position in that stock or in that basket of stocks so as to be able to maximize returns. So we have seen the 4 keys of successful investing. Once again, to repeat those: set your goals, do enough due diligence, ensure that you do a rational allocation, and follow an active monitoring policy. And last but not the least, it is disciplined practice which will basically lead to whether you developed exceptional returns out of your portfolios or you develop acceptable returns. I'll stop here. Thank you very much for listening, and I'm happy to answer any questions if you have.